Good morning, value and dividend growth investors. Welcome back to another video from me. In today's video, I want to talk about CVS Health Corporation. Several of you have asked me several times to have a deeper look into this company because I've never discussed it so far. So that's what I'm going to do today. And how I will do this is by showing you how I analyze this company, because it's effectively a new company to me. It's not like I never heard of it, of course, but I've never looked into it. So today my approach will be a little bit different. I will really show you which steps I take to analyze this company to come to a conclusion whether I want to do a full deep dive or stay where I am. But before we get started, I really would like to take a moment and thank the sponsors of today's video. So thank you, Romain, for buying me 10 coffees, Christoph for buying me 2 coffees, Gia Helms for buying me a coffee, and Thomas for buying me a coffee. This is truly appreciated and it keeps me going, and I can tell you I put a lot of time and energy in this video. So once again, thank you. If you would like to contribute with a coffee as well, there's a link in the description of this video towards the Buy Me a Coffee webpage. Thank you once again to the sponsors. So let's get into it. First of all, let's look at the dividend history. So I've got my dashboard here together with Engineer My Freedom. And what you can see here is like something that of course really appeals to dividend growth investor. And that's a rapid growth of dividends since the financial crisis from about 26 cents on an annual basis to $2 in 2017. From there on, it stayed 5 years flat and then it started growing again to $2.20 last year and $2.42 for this year. That's twice in a row a 10% dividend hike. So it seems to be that the company is back on its former growth path. But it also indicates that the company has probably been struggling over those years, and it shouldn't be a surprise because COVID was happening here. But nevertheless, their dividend growth policy is really to grow dividends when earnings permit, and you can read a little bit more here. So this is the company from a dividend growth perspective. 26 years effectively since the company went public, they have not cut their dividend yet. Okay, so let's get started. I don't know this company further, and where I typically start is the investor relations website. And on the investor relations website, there are a few things that I typically look into. The last annual report, so not even the quarterly earnings result, but the last annual reports. But even more when it comes to pharma companies, I'm really interested in their JP Morgan Healthcare conference details. And what you can see here is that they have a presentation. And also, to have a bit of a more recent view, I will also look into the Bernstein's 39th Annual Strategic Decisions Conference. So if you look at the presentation here, they always start nicely with an introduction, and that's why I like these presentations, because they are really targeted to investors. And what I learn here is that CVS Health has a total estimated revenue of about 309 to 314 billion, separated over 3 business functions: Aetna, CVS Caremark and pharmacy. And you can see that they are approximately kind of, really big gorillas here, because this one is generating 90 billion of income, 163 billion of income, and about 103 billion of income. So there's no pocket money, I would say. So if we go further, it also talks a little bit about their vision. And this is already where it starts to become a bit more difficult for me, because I am not a US citizen. I have no interaction with this brand at all. I don't see their stores. I don't see anything from them. So it's a bit hard to grasp, I must say, as a foreigner to the United States. So from here, I won't go deeper into this document with you. Read it at your own. The link is available via the investor relations website, but you really need to understand a little bit their business better. So luckily in the annual report, they describe a little bit more about it. So it's really focused on the health insurance business here with consumer directed health insurance products and related services. Hey, that's what I get. And in this case, it's heavily also dependent on Medicare. So the second line of business are pharmacy services. I understand this as well a little bit. So think about filling drug prescriptions, medication counseling, one-on-one counseling to help you quit smoking or manage diabetes. This is their largest business unit. And the third one is retail. And this is really the pharmacy shops that we also know in Europe, of course, where you just go straight away with your prescription to get your drug. So, okay, this made it a little bit more clear to what CVS Health is doing for me. And based on this high-level understanding, I feel comfortable to go a little bit further. So I went into the Bernstein Strategic Decisions Conference, and they had a nice fireside chat with their CFO. And what I learned here is actually quite interesting, because at the Bernstein conference, there's what I like, not really beating around the bush. So what they're asking is like, hey, can you frame a little bit the long-term vision of CVS? What do you expect it to look like in 5-10 years from now? So what the CFO says, and this is interesting, is that their challenge for CVS in the past has been 3 major business lines. 2 of those business lines, the healthcare benefits business and what we used to call pharmacy services segment, they have effectively kind of a core earnings growth assumption of the mid-single digits into the high single digits. And then the retail, so the pharmacy, let's say, has been flattish over time. So what he's saying, based on this knowledge, they are trying to pivot away a little bit into what they see as an opportunity is value-based care. The CFO is even more bullish on it because they have seen that over the last two administrations, so both Republicans and Democrats, they all want to move with Medicare more to a value-based performance setup, let's say, by 2030. So they believe by pivoting into this direction that they will be well prepared to support what the government is aiming to achieve. And by that, they believe that they can add an additional 1 to 2% growth rate on top of that as a company. Now, the next question that I found really interesting was a challenge on their earnings forecast, because they are saying that they could make like $9 next year and then $10 earnings per share the year after. So surprisingly, the answer of the CFO was not so bullish, because what he's mentioning here is something about a loss of a 4-star position in 2024, and that's going to have a significant hit. Hey, wait a second, what is this? So I just looked it up briefly, and what I found here is a Forbes article listed from October last year, where it was mentioned that the fall for CVS, particularly in the share price at the time, can be attributed to a downgrade of its largest health insurance plan for Medicare patients with 1.9 million members. The reduced rating implies that the plan's ineligibility for performance-based bonus payments from the government in 2020-24. So yeah, this is quite a bummer, and I understand now why this is going to have a significant hit, because if you're depending on Medicare and you're downgraded, you effectively get less income. So as a result of that, instead of what you see at the growth, they think that their adjusted operating income could be even flat with all those headwinds. He also lists a few upsides when it comes to their earnings, or potential upsides that can contribute to that. It's their biosimilars business that will mature later in the year, so they have some earnings expectations there. Then they also say they have a significantly sized exchange business currently generating to 4 to 5 billion in revenues, but it's not really making any profit. So they want to reprice it so that they can start earning money from this. Last but not least, they think they can really save a lot on their expenses in general administration, especially after they made some acquisitions, so that they can also pull back some investments in certain areas. Because yeah, if you have several companies acquired, then there's usually some synergy there. So this rang a bell to me. I thought like, oh, wait a second, did they acquire some companies? Yeah, they did something earlier on, right? And that's where I went to Wikipedia, because Wikipedia typically has several nice history pages about this. And here they said in 2018 they acquired 8 now. We saw that already. It's integrated as one of the business lines, generating around 80 billion in sales. And then last year and this year they acquired Signify Health and Oak Street Health, both for 18 billion together. So we'll see that later also on the balance sheet, because it had some impact there. But guys, these were some highlights that I took out of those presentations towards investors. I find them always very insightful. But there's another thing that I always like to do, specifically when I'm looking up the credit ratings, because it has a Baa2 credit rating, and that surprised me a little bit for such a mature company. So what's going on here? So if we then go to Moody's, where you can create an account and just log in and read the rating that they have given, they say here that CVS benefits from broad industry reach and solid industry fundamentals, including good store traffic, rising prescriptions, and increasing doctor visits. So that's kind of the bull case. And therefore, they also feel that they have strong cash flow, which supports the deleveraging of all the acquisitions that they have done. And we'll get back to that later a little bit. But what they then also said here is, like, absent other large acquisitions, we anticipate lease adjusted gross debt EBITDA of 3.5 times over the next 12 to 18 months, including an adjustment for opioid liabilities. I think, like, oh, damn it, there we go again. Opioid, of course, they were also part of that. So what I did from here, I looked also at what's going on with opioid, and the best place to really go here is just their annual report. So I went to the annual report, and here I see opioid litigation charges, 5.8 billion. And needless to say, because this is the income statement, this had a high impact because their net income was 4.1 billion. So without the opioid litigation charges, it would have been probably somewhere around 9 billion bottom line. So that's a big miss, of course. And you can see here they were making almost 8 billion in 2021 and 7 billion before. So I think their real earnings power here would have been 9 billion. But that's not enough for me. Maybe there's still more. So I also read further all on opioids, and let me show you. Okay, so here we go. In the footnotes of the income statements and such, there's a title called Litigation and Regulatory Proceedings. And this is really where a can of worms is being opened, because it's 6 pages of litigation, subpoenas, Department of Justice investigations is just too much for me, honestly. When I see this and people complaining about tobacco stocks, CVS Health is really, really not better. It's a wolf in sheep clothes within pharma providing healthcare. But look at this, unbelievable. So there's a whole history about the opioid case. It's really worth reading, I would say. But when it comes down to it, they have been settling with the majority of states. I think out of 45 states or something like that, 3 states not. So with this, they have settled with almost all entities. So usually that's where the big money is. I don't expect such a significant impact also from private citizens filing a lawsuit. But because of this, the company expects a cash impact in 2023 and 2024 to be less than 500 million in each year. Because it's already deducted from the income statement, we will see this more into the cash flow statement because it will be cash outflow. Okay, from here I've seen enough of CVS actually. I feel already like I don't want this company. There's too much going on here. It seems to really struggle. It seems to pivot also a little bit into value-based care, which is, from my experience, not an easy transition. They have a lot going on in their business. It's not easily growing, although management is slightly optimistic. But okay, you know, sometimes this might be just really, really an interesting value play. So let's have a look at that then. Okay, so if we look at CVS Health basic trends, what we can see here is that their EPS has really been going nowhere over almost the last decade, you see, almost no growth. Although the company expects a $9 here, there's always some adjustments. And this is, for me, something like IBM. There's always something going on for them to adjust. That's why their adjusted earnings are so important. However, on the free cash flow side, they are doing really, really well. And the nice thing about the free cash flow is that it's really amply covering the dividends and the share repurchases. So from a payout ratio point of view, this looks really good. We can also see in the shares outstanding the impact of the 8NAC acquisition. Since then, they have been slightly buying back shares as well. And the balance sheet looks actually pretty good. After the acquisition, they've been significantly paying down debt, but then with the last 2 acquisitions, it shot up, of course, a little bit again. But at least, you know, if we combine the equity to the shareholders and the cash and cash equivalents, it looks pretty good. But I understand why it gets a Baa2 rating, because you want to see this debt much lower still for a company like this. So really quickly then, why is their free cash flow so much higher? Because that's interesting, and I can straight away see it already. What they are showing here is not a free cash flow statement that we're typically used to, because what it shows here is like how much cash they received from their customers, 313 billion. And effectively, this is kind of also a profit and loss statement, because what they say then, okay, cash paid for inventory and prescriptions, 190 billion, insurance benefit paid, 70 billion, cash paid to other suppliers, 32 billion, da-da-da-da. If you all deduct this, you get 16 billion in pure cash flow. Now, minus the purchase of property, plant and equipment, and yes, you have around 13 billion in free cash flow over 2022. So that's why this company is just so cash flow rich at this moment in time. And the question is, of course, should we use this for our evaluation? I'll get back to that in a second, because I'm now at the state where I say, like, okay, you know, knowing all this, is their dividend safe? And in my opinion, it is probably on the safe side, but I also rate it as questionable. Why? The earnings is hardly growing. This is really an issue. Although the company is slightly optimistic here, and I understand that because they look at adjusted EPS, but you know, they have 10 years of adjustments. So what confidence does it give me that management will stop adjusting and that we will really see this $9 of income per share? I have hard doubts there. The balance sheet doesn't score too well because of the ratings as well, so it loses a lot of points here. The interest coverage, I would like to see it a little bit higher for this company. It scores, of course, a lot of points on the payout ratio because it looks really good, but also their 5-year dividend growth rate is not the best. They didn't hike their dividends during COVID. So yeah, this company can do better, although of course the last 2 hikes of 10% do look promising. So maybe this could be even still a little bit higher, maybe 60 or 70, but it's really not one of the higher dividend safety profiles. I also rate the company's growth prospects on neutral. I would even consider weak, because I just don't get bullish on this company based on what I've just read. And maybe I just went down through the wrong wormhole. Please let me know in the comments below if you have a much more optimistic view. But hey, that's what my analysis tells me, and that's where I stop. So So if we then start to evaluate this company, let's use then the net income numbers, because I find it a little bit more reliable number, because the cash flow statement and how they have designed it is something I'm relatively unfamiliar with. So let's take this one, and then let's look at the analyst ratings here for next year. If you go to Koifin, you will see there that the GAAP earnings forecast is about $7 per share. So if you do that times 1.3 billion in shares outstanding, you get around 9 billion in net income forecasted for 2023. So that's what I've been using here. I'm not assuming really a growth in the next 5 years and then 3 years, 3% thereafter. So I'm really not so optimistic about this company, specifically that I think there are still a lot of adjustments that will put the EPS down over that period. Discount at 12.5% and a terminal multiple of 10 would give the stock a fair value of $64. The company is currently priced at $75, so it would mean that in my bearish view, I realize I'm bearish, the company is still overvalued. Another reason why I'm bearish is also because if you look at the return on invested capital, which was about 6%, and the weighted average cost of capital was also around that number, you can see that the company has not been adding really value over the last few years. So all in all, for me, this is just really a poor quality company at this moment in time. I might be wrong. It might be that the acquisitions will really be a boon for the upcoming few years, that the dividend will be in stellar growth, the earnings will be popping up everywhere. But honestly, guys, I just don't see it. So I've got a more optimistic case here that puts it at $80 if it will grow 2% and then 5% thereafter. So if you're in that camp, hey, this company might be fairly priced. If you're even more bearish than I am, then the company's worth $52. So you get it already. My conclusion is I'm staying away from this company. There's just too much stuff that I don't like, but also that I don't understand. I don't live in America. I don't have any feeling to CVS, but maybe that also makes me a little bit more objective. Well, guys, that's it from my side. I really hope that you enjoyed this video. I approached it a little bit different today. I showed you more like a detective, how I'm going to the numbers to see what this company is about and what I'm finding here. I hope you find it useful. I hope you learned something from it. This is it. Have a good day and see you at the next video.